Welcome back to Yahoo Finance Live. It's time for our chart of the day. And this one on this Tuesday, March 15th, comes from the Bank of America's Fund Manager Survey, hot off the presses from this morning. And it shows a notable shift in sentiment among investors between February and March. They asked the question, do you think stocks will fall by more than 20% this year, also referred to as a bear market? And in February, only about 30% said yes. But when they asked the same question in March, 60% said yes. And keep in mind, this isn't just randos on the street, right? These are so-called smart money or big wigs at the big funds. But keep in mind, we've already lost about 8 or 9%, 10%, depending on what index you're looking at, just since February. So maybe saying a bear market is coming isn't so much of a bold call. But the question naturally is, does the average retail investor feel the same way? We'll get some perspective from Dan Egan, Director of Behavioral Finance and Investing over at Betterment. And Dan, again, the bearish sentiment, you can't hide the fact that it's coming out of the hedges a little bit. But what are you seeing in terms of users on Betterment in terms of whether or not they're worried about a stock market bear situation? Are they trying to reposition? Are they freaking out? What are you seeing?
So far, we're not seeing any strong bearish sentiment. Back in March, April of 2020, this is sort of the canonical example of what tends to happen. Out of 1,000 investors, 6 of them do something, whatever that thing is. Of those 6, you'll see about 3 of them go defensive. That means either withdrawing money or having a more defensive asset allocation. 2 of them are actually going to get more aggressive. This is the sort of buy the dip behavior that we've seen develop over the past decade. And the last one is going to revisit their financial plan, maybe push their goals out of it. So net, we're seeing 1 out of 1,000 people do something defensive during large market down. So generally speaking, there is not a lot of bearish sentiment. Normal people just have a continual buying every 2 weeks type mentality. On the other hand, what we do see during these periods is new investors stepping back from pulling the trigger. Existing investors who are experienced, they have no problem. They see this and they've been through the Trump election, Brexit, numerous numbers of little downturns that have taught them this is generally short-term and will pass. But new investors who don't have that robust experience get spooked by downturns such as this and end up waiting and waiting and waiting.
This is a really interesting point that you bring up, because I guess it doesn't necessarily mean that if you feel like a bearish market is coming, that you have to get defensive. In fact, that's not necessarily what the Fund Manager Survey is saying anyway. You can believe that a bearish market is coming and then just hodl effectively through all of that. But what types of strategies are you seeing for those that are doing the hodling, right? Are they trying to stack up more on those higher yield, risky, for example, growing tech stocks, or are they kind of still gravitating towards big chip names or other types of strategies like that?
It's a great time to just revisit kind of what we consider as good standard portfolio hygiene. So number one, this is a good opportunity to rebalance and do it in a way that maximizes the tax impact. So you can tax loss harvest any positions that you have losses in, use those to offset ordinary income tax, get your portfolio back to an asset allocation that makes sense given the time frame that you're investing over. And a lot of our clients do tend to dollar cost average either through their 401k or directly into a taxable account. Right now is IRA season, from now until April 15th, when people know they can put money into a traditional or a Roth IRA. This is an opportunity to sort of accelerate that, use this dip as a point in time to say, I know markets aren't at a local high right now. Let me put my money to work when it feels a little bit more comfortable. So we're seeing a little bit of that opportunistic, let's do something we were going to do anyway, but let's bring it forward to a point in time when we know we're not going to be buying at a local high.
And that's another interesting point that you bring up about just kind of 401ks and kind of putting your money into a retirement egg as opposed to some active investment portfolio. Do you feel like the passive investing kind of craze has been continued over the course of the pandemic? People who might be saying, you know what, I guess I could buy a lot of SPY, but maybe instead I could just put my money into a 401k, into a large, fund index and just let it fly like that.
This is one of the biggest sort of bifurcations that's happened in markets, I think, since about 2017, is that people are both staying the course, doing this almost kind of rote thing of putting their biweekly deposit into their 401k, investing in IRAs, just letting things sit passively. And that's just like a relentless buy that comes more out of their income than any sort of view on short-term markets. Looking at the sort of more opportunistic trading behavior, that's something that really blew up in about May of 2020 when stimulus checks came out, where we didn't have a lot of stuff to do. We couldn't go out to, dinners or ball games, et cetera. There's a great study that came out that said about 15% of stimulus money ended up getting invested into specifically the stocks that retail investors were blowing up, your AMCs, your GMEs. So there's this really strange sort of like duality of investors right now where most of their money is going into good, responsible, long-term retirement vehicles like Betterment. And then there's this little slice that they get to play with that's their excess or their stimulus money that they go in and they put into very concentrated positions to see if they can win the lottery. Both of those things are true concurrently. It might even be the same person doing it.
It's really interesting. I mean, look, AMC still in the news today. I mean, last question here, when we talk about just kind of approaches here and just kind of how much people want to be invested in the stock market, is the reverse of a defensive position actually happening where people are taking a higher share of their paycheck and putting it into either a retirement account or into some sort of investment portfolio, knowing that, with the lack of stimulus coming in this year compared to 2021, 2020, now is the time to kind of boost up that savings that you have?
I think we saw a lot of that with the stimulus check back in 2020. We definitely saw deposits into safety net funds on our platform, Gov. I think a lot of people said now's the time to bump it up from a 3-month to a 6-month to a 9-month type safety net fund. We're not seeing anybody really kind of take that barbell approach in terms of risk right now, specifically because we see risk everywhere, i.e. if you're looking at a short-term interest rate, you're still looking at negative yields. Inflation is on everybody's mind, which is its own risk. Generally speaking, we're seeing people almost close their eyes and say, I am just putting money into work in a retirement account consistently. I know that over 10 or 15 years, the small short-term things that are happening today are not going to affect my outcome there. It is only when you have sort of short-term needs, which we generally say, put it in a safety net fund so that you don't have to worry about it. That's what motivates very high concentrated risk-taking behavior over short periods of time. That feeling of pressure that you need to win over a short period of time.
All right, Dan Egan, Director of Behavioral Finance and Investing over at Betterment. Thanks so much for joining us this morning.